Good morning. Welcome to Trading Hour. I'm Reema Tendulkar. With me is Sonal Bhutra, and we're waiting for that mega exclusive interview with Chris Wood and what he's made of the Powell booster shot, the outsized rate cut of 50 basis points delivered by the Fed yesterday. Let's take a quick check on how markets have reacted. Well, in the morning, it was a gap-up opening. The Nifty first crossed 25,500, went on to scale a new peak of 25,612. But from there, we've lost about 100 points from the top on the Nifty. Still holding up in the green for the benchmark indices. But again, 100 points gone from the session highs for the Nifty and even for the Sensex. The problem is there is absolutely no momentum in the mid-cap space. The mid-cap index is now down nearly 1%. The small-cap index is a bigger cut. The advanced decline ratio stands at one stock advancing, about two stocks advancing for five stocks declining, and the gap between the two is only widening. Now, the reason why the momentum in the market is faded is IT. Now, IT opened straight away with a gain of about 2.5%, recouping some of yesterday's gains. So pull up the Nifty IT index, but now the Nifty IT index is down in the red. So that's problem number one, 1/3 of a percentage point. But what's holding up in the green are FMCG names. NTPC is, of course, the top gainer. But as promised, let's cut across now to Prashant, who's in conversation with Chris Wood, the global head of equity strategy at Jefferies.
Hello and welcome to this special program. I'm sitting down with someone who is was regarded as one of the world's foremost equity strategists. I'm sitting down with Christopher Wood at Jefferies, and what a day to sit down with him from the sidelines of the Jefferies Investor Conference here in Gurgaon. Chris, great to have you with us here. Thank you very much for your time. I said what a day to sit down with you because we're sort of coming out of this 50 basis point rate cut from last night. What do you make of it? I know you were expecting 25, but here we got 50.
No, I'm genuinely surprised by the size of the rate cut because it's contrary to the messaging of the Fed going into the meeting, which is that the economy is okay and the employment market is weakening, but only gradually. So, yeah, if you talked to me yesterday, I would have said 25 basis points. I think there was an article in the Wall Street Journal suggesting it might be 50 at the weekend, so that was probably the clue that they were going to go bigger. But bottom line is contrary to the messaging going in. But the key point here is what the Federal Reserve believes is the neutral rate. So my guess that is probably in the 3 to 3.5% range. So even if the US achieves the soft landing, so to speak, we're probably going to be at between 3.5 by the middle of next year. But in terms of the short term, I'm surprised I'm surprised it's 50 basis points.
Do you think it's got a political angle to it as well, with elections in November?
My guess, given the fact that whatever they might argue today is quite anybody who can read and listen is contrary to the messaging going into the meeting. So my guess at the margin is political. Because it's pretty clear that probably the vast majority of members of the Fed would prefer Donald Trump not being elected.
I see. And
I'm sure the Republican candidate will view it as political.
But does it help at the margin?
Maybe. I'm not sure it does help. Maybe at the margin.
Okay. I want to come back to the U.S. political sort of elections season in just a bit, but we don't see 50 basis point cuts without a crisis, either very apparent or, I mean, something which they're worried about. But
there could be conspiracy theories that they know something and the economy is much weaker than which is a risk of them cutting 50 basis points yesterday, actually. But my guess is they actually genuinely believe the economy is okay. So that's why I think the motivating factor is political. And there clearly are some members of the Fed who are very political. Former New York Chairman Bill Dudley has been calling aggressively for a 50 basis point rate cut. If I remember correctly, he was the guy who once wrote an article calling on the Fed to manage monetary policy in a way that could stop President Trump being elected in the previous election. So I think there have been quite a lot of people calling aggressively for rate cuts, saying the Fed's behind the curve. But that's not the message transmitted by the Fed chairman, Mr. Powell.
Do you believe the economy is solid?
I believe the economy is obviously the economy is okay right now, but I still believe there is a risk of a U.S. downturn because of the big lags in monetary tightening in this cycle. So if you look at a chart in my presentation I gave this week, there's a chart of M2 nominal GDP growth, which had a huge explosion back in 2020 when they printed all that money in the pandemic. And actually, while the M2 growth has slowed sharply in the intervening period, while the Fed has been tightening, if you draw a trend line from 1997, the M2 to nominal GDP ratio has only just gone below the trend line, which is a long-winded way of saying that in liquidity terms, the monetary tightening is only just beginning to bite. And you know, the labour market is weakening. All we need for the Fed to be cutting 50 basis points every meeting is one unambiguously bad labour market
data.
Yeah.
And you get another 50.
Yeah, but then the market will be discounting 50 basis points every meeting.
Okay. The Fed themselves in the dot plot is saying that there'll be 2 more 25, right, this year, in 2024. At this point, that seems likely, or you think it'll be more than that?
Yeah, but I don't really pay any attention to the dot plots. What's important is the data.
Okay.
I mean, the dot plots are important in the sense of what the Fed think, but I wouldn't invest any money on the dot plots.
Okay. So let's assume that it's a normal kind of an economy, maybe a little slowing at the margin, but no crisis, nothing panicky. And you have these rate cuts which have started. Let's just assume it's 50 now and then maybe another 50 through the end of the year. What does it mean for asset classes like equities?
Well, it's good news it should be good news for emerging market equities, because in most emerging markets, particularly here in Asia, central banks all year could have cut rates for their own domestic reasons based on the level of real rates and inflation. But in the vast majority of the cases, they chose not to cut rates because they were worried that they might undermine their own currencies. And in the specific case of Indonesia, which has the central bank has a currency stability mandate, they actually raise rates despite very high real rates. So basically, all these central banks will now have room to cut rates, and hopefully their currencies don't get hit. So far, basically, the dollar has been in an increasingly clear weakening trend. Yeah, so that's basically good news for emerging markets.
So EM's more than US?
In my view,
in
yes.
an easing cycle?
Yeah, in my view, yes, because in the specific case of the US, the interesting point is how resilient the US listed companies have been to the Fed tightening cycle. And that is explained by this extraordinary statistic that the net interest payments of the US non-financial corporate sector have declined sharply in this Fed tightening cycle, which is counterintuitive, but it's the reality. And that's because the big tech companies have been earning 5.5% on their cash, where they used to earn 0. And it's because the investment-grade corporate sector in America did a very good job locking in bond yields when they were low, refinancing their debt. So if the higher rates actually were positive for them on the where the lower rates will help is the SMEs, because they don't issue bonds. And that's the big surprise. SMEs in America have been paying between 9 and 10% to borrow money for the last year. And that's why I'm genuinely surprised how resilient the labor market has been. Yeah, because they employ most Americans.
What about India, Chris? I mean,
well, in the case of India, the RBI can cut rates like
later this year.
All Asian central banks can cut rates today, including the RBI. But my colleagues here, we believe the RBI is not going to be aggressively cutting. I.e., the RBI is going to behave in a different way from the Fed. And actually, the RBI in recent months has been actually counter-cyclical because they've been doing these preemptive regulatory measures as regards the banking system. And so I would assume the RBI will cut rates once before the end of the year, but I could be wrong.
Okay.
And they can cut rates because...
That's the consensus. First cut by December of this year. I
think the RBI would be coming under criticism if they haven't cut rates by the end of the year, because if you look at the level of inflation, particularly core inflation, is below the level of rates. So you have positive real rates. But obviously with the stock market at all-time highs, huge domestic flows getting to the stock market, the RBI doesn't feel under massive pressure to cut rates today.
Yeah, no, absolutely. Chris, what about flows into India? Because the market here has been marching to the sort of drumbeat of local investors putting in money, and that number has sharply increased. It's about $4 billion regularly a month coming into mutual funds. It was about $2 billion a month before elections. So actually post-elections, the number has gone from $2 to $4 billion a month. I remember you were surprised when the market here, barely shrugged in response to the election.
That was a big surprise. That was a big surprise to me.
And of course, after the capital gains...
well, that's actually the biggest surprise to me was the second.
Yeah.
So after the election, clearly it was only one-day sell-off, but then I think the market's reaction was explained by the fact, when I came to Delhi shortly, it was clear that everybody believed this government could last 5 years with the two minority parties. So that became more explicable to me, but I have to say I'm genuinely astonished by the resilience to the capital gains increase, which is quite material, most particularly as a week before I met many domestic institutional investors, and they were not expecting the capital rate gains tax increase. So I find that...
and many of them were very vocal that markets will be hurt.
Yes, I would have been too, so we've all been completely wrong. So the only explanation is that the domestic households who are investing through these monthly installment plans have become convinced, in my view correctly, that India is a good long-term equity story and don't want to be scared out of the market. That's the only... And the big story of India this year is these domestic flows.
Yeah. But what about foreign flows? You said that easing cycle is great for EMs. India is an emerging market. Foreigners have stayed away. I mean,
but on a relative basis, if you're investing, if you're an EM fund manager, after this 50 basis point rate cut yesterday, the markets you're going to want to add positions to are places like Brazil, which have 11% nominal rates, 5-6% real rates, so huge potential to cut rates. Markets in Southeast Asia, like Indonesia, Philippines, which are traditionally very sensitive to lower US rates, weaker US dollar. So India is not the obvious place to put your money in today, because one, it's expensive, and two, the RBI is in no hurry to slash rates.
But haven't, well, I mean, you've been at the conference, you've been speaking with a lot of foreign investors who are here. What's the sense you get about India? Yeah, it's expensive, but it's been expensive. You could have made the same argument 3 months, 6 months, a year ago.
The people who are, obviously the people here are already invested.
Right.
And so their issue, they're not too hung up on the valuation. I mean, they're all concerned about the valuation.
No, we're talking about incremental flows into the Indian market. I mean, what's the sense you get on that? I mean,
well, my sense is, yes, the problem for the foreign fund managers as a whole is that they are underweight. Based on our latest data, based on the top 30 global emerging market equity funds, they're now marginally underweight, which is not where they want to be, because most of them would agree with me that this is the best long-term story. But they're underweight. They've become underweight from a de facto standpoint. One, because they've been reluctant to pour money in because of the high valuations. Two, because this is a very important point, the neutral benchmark weighting of India has just gone up a lot, which has made them become underweight by market performance. But there's an additional issue. There are two sectors where the two sectors where foreigners have traditionally most invested in India have ironically been underperforming, i.e. IT services and banks. So in the last year, many foreign investors, particularly value-orientated investors, would have gone into the banks for the first time because they came within their valuation range. But you know, they're not the hot areas of the market. The hot areas of the market in India have been areas like industrials, infrastructure, real estate, energy, defense. These are the areas which have been driving the market. That's not the area traditional emerging market investors have been investing in.
So you don't think that foreign investors are going to come back to India in a big way?
Not in the immediate term, but the good news about this is the really positive point to take away is any major correction in India, like say 10%, in my view, will be viewed by foreigners as the opportunity they've been waiting for to add.
Are you still expecting a 10% correction?
No, I'm not. I'm just saying that's...
I mean, someone said 5 is the new 10 and maybe 2 is the new 5.
No, in my view, I've got a greed and fair long in the India portfolio. I'm not going that defensive in it.
Okay.
So, because the point is I can afford a correction, I've got very good performance. But my portfolio is heavily in energy, real estate, capex plays. But I have got the bank, so that's, I suppose, the conservative part of my portfolio.
Okay. Okay.
But the real issue for foreigners, I think the more foreigners know about India, the more specialized they are in the market, the more relaxed they are on the valuations. It's just the generalists are the more concerned. And global investors, as opposed to global emerging market investors, barely own Indian equities at all.
So the
I'm
point,
talking about global funds.
right? Not EM funds, but
Yeah,
global funds.
They barely own India at all.
At all.
Yeah, literally, they don't own India.
So it's a strange kind of a position, right? I mean, because you're saying is a best long-term
Yeah, so
story.
many global investors will agree that India is now the best story, but there's a practical issue that if you only invest in India via AGRs, you have extremely limited choices. Because of the lack of ADRs quoted offshore, unlike in China, there are many ADRs. And the second practical issue, if you want to invest in India in a sort of more real manner, you have to get FII approval, and that is a regulatory obstacle, right? That requires a real commitment. So most global funds have not got FII status.
Is that such a big issue? I mean,
Yes, that's an issue. Don't underestimate that.
Yeah.
So a big fund management company could have their global emerging market fund with FII status, but their global fund may not have it. And then this capex increase, or capital gains tax, will now become another, will now put them off.
You know, in your note, I think the last but one note, you did mention that you put in that capital gains, and you said, well, that worries you.
Now, that personally, I don't believe in capital gains taxes on equities because people have already earned the money and they're risking. They should be encouraged to invest in equities. Now, obviously, you can deduct the money you lose, but that's just a philosophical point. So, obviously, the government's raising.
No, but did you mean that in the context of where India is in terms of the political?
Well, no, that is an issue because in most Asian markets, you do not pay capital gains tax. But be you domestic or foreigners. But there's another technical issue where if you're running a dedicated Indian fund, or you have to make a provision for that capital gains tax, apparently, even if you haven't sold the stock.
Okay.
See what I mean? So if you're a fund manager, you're kind of starting behind the benchmark.
Because of this?
Yes.
Okay.
So that is actually a negative, yeah. That's a negative for people trying to do dedicated Indian funds offshore.
So do you think this? I mean, India's weight has gone up, right, in the benchmarks. But do you think foreign funds will stay underweight for some time? I mean, that underweight position can actually even widen if local investors continue to put in money and the market continues to do well.
The direction of travel is foreign ownership is declining relative to domestic ownership. Fundamentally, this domestic flows are just extremely positive. And we estimate Indian households have 6% of their assets in equities. Though none of us are expecting the recent pace of flows to, by every law of logic, they should slow down. As you say, it's remarkable they've picked up since the election.
I mean, it's $4 billion a month now, on a regular basis.
But from a macro standpoint, at this conference last year, we were arguing that we were in the early days of a capex cycle, but you couldn't really show data comprehensively proving that. Actually, the best evidence we were in the early days of a capex cycle a year ago, 15 months ago, was that capex stocks were rallying.
Sure.
But there wasn't the actual data. But now there's real data highlighting that the private sector capex cycle's underway.
But do you think, in a lot of ways, across sectors, I mean, stocks are already pricing a lot of this in India? I mean, capex stocks, for example.
So tactically, you would be a bit more cautious.
You would be.
Yeah. But I'm not. I've got these long-only portfolios, and I believe this. See, the last time India had a capex cycle, which I would say was like from 2002 to 2009, India massively outperformed the rest of Asia in that period. I remember it clearly. So if this capex cycle is happening, structurally, I want to remain invested in the story.
Even if they go through periods of underperformance, but eventually it'll. I mean, it's a great story.
Plus, we have the residential property story, which
you've been very bullish on.
Yeah, and we don't think
You did highlight that last quarter there was a bit of a slowdown, but
Right, but that, I would view all that as a pause to refresh.
okay.
So we've gotten good news of if there's a weakness to the residential property story, which has been dramatic here, right? And, if there's a weakness, is very much focused on what they call the high end, which I suppose in the US, well, it depends what city you're in.
The premium end has done very well.
Yeah.
You're saying that perhaps sees some.
Well, what I'm saying, if you're going to criticise it, you will say it's very vulnerable because it's just the high end going up.
Okay.
But I would say, in response, well, I would have to admit that's true. I would say that's normally how property cycles work. They start with the high end and they gradually trickle down. And in that sense, rate cuts would help because if you go under 200, to use dollars, not if you go under $2,000 for a unit, you're probably going to get to levels of more rate-sensitive buyers. And so if rates go down 200 basis points here or 150 basis points, that's going to increase the number of people who can afford it.
Right. So for
I've heard that I think I heard this week that inventory in the top 7 cities is at a 14-year low.
Yeah.
So if that's true, we can definitely keep going for another 4 years.
In terms of this cycle, in terms of real estate build-up?
Yes, because we've just entered our 4th year of an upturn.
Okay. So you're saying another 4 years.
Obviously, we take it a year as it comes, but given the fact that we had a 7-year downturn,
right,
given this multi-year inventory low, given the fact that India builds far fewer residential units today than even China, given its current problems builds, there's no reason to think why this suddenly blows up.
So tell us the sectors or places that you're most bullish on now, Chris. If somebody is trying to put fresh money to work here, what would you?
Put it in today. So I'm not taking out. I've got 19% in real estate stocks in my India portfolio.
Okay.
Now,
what else have you?
If I was starting the portfolio today, I might be a bit nervous putting 19%. But given the fact I have 19%, they've done well already. I'm not going to actually reduce them.
Okay.
But if I want to have a more cash, let's say I can't own cash, but I wanted to be more tactically cautious. Because I've got more short-term tactical considerations, and you want to own the stocks which are more neo-cash proxies, which I would say are like the banks or the consumer staples.
So I mean, perhaps there's a little bit of underperformance. I'm not sure. Banks have valuation comfort. Consumer staples maybe not so much.
No, but they're still, because we've got. I think we have evidence now that the rural economy is finally picking up, right? So I can see a case for adding to those tactically.
But if you were looking at slightly beyond the very near term?
Looking beyond the near term, I'm sticking with my current portfolio.
Okay.
So the issue with
which is 19% real estate, what else?
No, it's big in capex plays and energy.
Okay.
And if any real correction in those areas, I'd be looking to add.
Okay.
Because I'm quite heavy in the banks, but the whole infrastructure story here in India, the energy story, these seem to be at the centre of the action, at the centre of the capex cycle.
Sure.
It's just very positive for an economy if you have both a residential property upturn and a private sector capex cycle going on. So the way I look at it conceptually is that the government in the last 10 years has spent a huge amount at the central government level building capex. Which has been the big driver of the fiscal deficit as opposed to transfer payments.
Sure.
So that's been the enabling factor for the economy, which should give the private sector confidence to invest. And we are now, in the last year, seeing that actually happening.
Absolutely.
Yes. So whereas a year ago, talking to people in the government, they were saying why isn't the private sector investing? So I was saying, don't worry, the private sector capex stocks are going up.
Yeah.
But obviously, if you're a government official, the stocks going up is not. You don't trust the evidence.
Absolutely. Chris, just one last point. You were cautious, right? You're telling me you're a bit cautious. We've got another round of elections, state elections coming up. Are they going to be important? Have you heard that as feedback from investors? They're watching it closely.
On the big stage, obviously we're seeing handouts, right?
Right. Across states, I mean.
Yes. So that's obviously I mean, that's another reason to maybe add to consumer staples. Tactically, long term, that's not so great, but that just means maybe the incumbent has a chance of winning where everybody thought they were going to lose.
But would it make a difference? I mean, even if the ruling party were not
No, that will create some negative noise.
Because, I mean, some argue that the general elections barely caused a bump, so why should this matter?
Well, I kind of agree with that.
You do?
My message, what I've picked up talking to government-related people this week is rather than passing lots of laws, the bigger focus seems to be on doing away with a lot of these regulations, which are a legacy of the what they call the license Raj. I think there's clearly a case for a bonfire of regulations to promote business.
That sounds like Elon Musk in America.
Yes.
Who wants to do the same?
Yeah, that's exactly right.
Absolutely. Chris, it's wonderful to speak with you. Thank you for sitting down with us. Appreciate your time here on CNBC-TV18. It's a pleasure.
Thank you.
Thank you.
Welcome back. You're still tuned into Trading Hour. Well, the Nifty has come off, of course, from the highs, around 140 points on the Nifty. From the highs of the day, it's up around 100-odd points, which is seeing a lot of pressure. That's the mid-caps and the small-caps. So the mid-cap index, that's down almost 1,000 points right now. It's off 1,400 points from the highs of the day. The high made was around 60,200 today. And from there has been a big slide that we are seeing. Even the small-cap index is down 2.5% as we speak. So big cuts that we are seeing across the board in the mid-cap index. Not very enthused by the rate cuts that we have seen, and that is something that is reflecting in these two indices, and the broader markets continue to be under pressure. But it's time to shift focus to the commodity space now. Manisha Gupta is joining in today, and today, Manisha, we are focusing on zinc. Tell us more.
Well, I'm looking at zinc prices, which even after a bit of a decline overnight after the US Fed meeting, are even now trading at a 3-week highs. Well, if you look at the year 2024, the high for this year has been $3,100 a ton. We did see a low of around $2,300 as well. But currently, we're looking at prices trading at $2,900 a ton. Well, the all-time high clearly was in 2022 at $4,600. So we are off those kind of numbers right now. Well, a few factors which are supporting zinc prices right now is the stimulus measures expectation from China, because all the data that has come in from China for the month of August and until mid-September has been on the weaker side, with expectation that China perhaps will do something more here. The second is Voda Zinc Norway smelter. The expansion now is getting delayed to 2025. So that means that the supplies would not come, which the street was accounting for in this year itself. The third thing is that the global zinc market seems to be tightening right now, because in the month of June, you are looking at surplus of 8,700 tons, while in the month of May, it was at 44,000 tons. So clearly, that is what the reaction that we have seen come in the prices already. If you look at the China zinc refined production for the month of July, also has seen a decline by more than 10%, also adding support to prices. Well, the LME inventories have continued to gain, though, up by nearly 2.5% on a month-on-month basis. But the street does believe that going forward, as we see infrastructure and demand within steel as well, so for galvanization as well, you could be looking at zinc demand continuing higher, and the support thus could continue.
Thank you very much for that, Manisha. We'll get into a break. On the other side, we'll discuss market technicals. Sudeep Shah from SBI Securities joins in on the other side. Welcome back. Still tuned into Trading Hour. A lot of stocks which are buzzing around in trade today in the broader markets on the back of brokerage notes, news updates. So let's get started with that. BrainBees Solution is surging after positive commentary coming in from BofA Securities. Mangalam is joining us now with more details on this. Mangalam, what does BofA say?
Well, it's a recent listing and 2 initiating coverages on this one already. The issue price was 465 and Bank of America Securities has initiated buy with a target price of almost 770 rupees. They're saying that the company is well positioned to post 21% revenue CAGR. In fact, they expect the EBITDA to compound at 57% as well. And international and global B's business can actually be big optionalities. In fact, we also have Morgan Stanley initiating coverage and they have a higher target price than Bank of America. So 818 rupees, saying that this is a quintessential play on the first cry business. So as a result of which the stock earlier was higher, but in line with the mid-cap index currently off highs.
Okay, thank you very much for that. By the way, big news coming in from the telecom sector and negative news. The Supreme Court has rejected the telecom company's plea by Vodafone Idea and Bharti Airtel on the recomputation of the AGR dues. Remember, the telecom companies, both Bharti Airtel and Vodafone Idea, went up to the Supreme Court in a curative petition saying that there are mathematical errors in the computation of AGR, annual gross revenues. They even sought a waiver of the penalty amount. The street was very hopeful that this would play out. In fact, we saw the stock price of Vodafone Idea go up to levels of 19 rupees. It was not a base case in most of the investor analyst expectation, but the street was hopeful. Now, this being rejected by the Supreme Court is a big setback. Now, AGR dues remain unchanged. For Vodafone Idea, it stands at a massive 70,000 crore rupees. The company themselves were hoping that it could come down by 50%, which would reduce the cash flow burden, which starts on the company from next year, H2 of FY26, October of 2025. That's H2 of FY26 is when the cash flows after the moratorium ends begin for Vodafone Idea. And analysts believe that in the absence of any relief on this, which is now the base case, it's going to be difficult for the company to meet its cash flow requirements. So that's the news. Just in case you've tuned in now, the Supreme Court has rejected the telecom company's plea, both Bharti Airtel and Vodafone Idea, for a recomputation of the AGR dues, which means AGR dues remain unchanged. That's a big amount and companies will have to repay it. This was the final relief, the legal recourse, right? They had gone to the Supreme Court before, it was rejected, and then they filed a curative petition. Not often the Supreme Court even hears the curative petition, but in this case, they heard it, which is why the street was hopeful. That said, history does tell us that the instances of a curative petition being positive are fairly rare. But, Bharti Airtel will still be okay. Its cash flow, it's a much bigger company. The cash flows are fine. So Bharti Airtel did see that initial dip, but you can see buying emerging because the street is very bullish on Bharti Airtel. One of the recent target price was nearly 2,000 rupees. But for Vodafone Idea, it's a big setback. In fact, we have Balaji Subramaniam, the IFL telecom analyst at IFL, and we've been talking to him about this particular development. Balaji, hi, morning. First, weigh in with this setback for telecom companies. Big news.
Hi, Rima. Thanks for having me on the show. I think this was something which the street was expecting in terms of the relief coming through. With that, that possibility now looking remote based on what the Supreme Court has done. It does look like, the climb for Vodafone will get stiffer because if this relief had come, the potential relief could have been to the order of magnitude of around 35,000 crores, which would have resulted in rupees 5 per share in terms of, valuation upside. And the other thing was that once the moratorium gets lifted later next year, the annual outgo would have been probably lower by around 8,000 crores. So now, with this relief not coming in, the cash flow position of Vodafone would be a bit more difficult compared to what would have been the case if the relief had come through. As far as Bharti Airtel is concerned, they would have also benefited from a favorable outcome on the case. But net, even otherwise, the other way to look at it is that more challenges for Vodafone Idea means there is potential room for further revenue market share gain for Bharti Airtel compared to what it would have been if the relief had come through. So I would think it's a slight positive for Bharti Airtel, despite the fact that they wouldn't be getting this relief, but it would be negative for both Vodafone Idea and Indus Towers.
One word answer. AGR dues for Vodafone Idea were about 70,300 crores, right? And for Bharti?
That is right.
And for Bharti Airtel?
So for Bharti Airtel, it's around 36,000 crores.
36,000. Balaji, do hold the line. We've got Ashmit. He's joining us more on the phone line for the latest here. Ashmit.
So again, a big setback coming in, primarily, of course, for the two companies, the two listed players, Bharti Airtel as well as Vodafone Idea. Both these companies had moved the apex court and had filed a curative application. In this curative application, both the companies had cited similar grounds, cited arithmetic errors. They had pointed out that the demand that was arrived at by the DoT was in fact preliminary in nature, that there are computational errors, there are instances of double counting of certain subheads, and that is what has led to this gargantuan amount culminating with the AGR demand. These were some of the concerns raised. Now, importantly, they had mentioned this matter before the Chief Justice. They had sought for an open hearing. They had sought for a hearing where the lawyers can make their case. However, this matter was taken up. Curative petitions is the norm. It's taken up in isolation within the chambers of the judges. No lawyers are present there. The applications are present, but the lawyers are not. The judges decided this matter within their chamber. The judgment has just been uploaded. It very clearly says that no case has been made out. The Supreme Court has gone through the applications that were made by the telecom companies, have gone through the concerns raised. But so far, the short note, the short point that the apex court is putting out, that no case has been made out for reconsidering the decision on AGR. There is no grant of relief. The application by the telecom companies have been rejected. So with that, the Supreme Court finalizing this AGR decision, this AGR saga, which has lasted for a better part of 2 decades now, the Supreme Court having the final word and saying that the AGR demands will stay, they have been upheld, and that there will be no change in the quantum of demand that was originally decided by the apex court.
That's right. Thank you so much, Ashmit, for joining in now. So this is the final nail in the coffin, and there'll be no changes to the AGR amount that is due by these telecom companies as well. Balaji, coming to you, for a lot of investors who were bullish on Vodafone, thinking that there could be some relief coming in for the AGR dues. The FPO price was 10 rupees per share. We saw the stock go as high as 19 rupees a share as well. What do you suggest the investors do now? Do you think there is any other trigger for the stock, or now it will continue to see issues because of the cash flow problems that this particular judgment has brought in?
See, I think it's a little too premature to kind of do, what exactly happens, because the debt funding part is also pending. The equity raise is largely done, but the debt raise is still underway. Now, what happens to the debt raise round because of this adverse verdict in the AGR case, that remains to be seen. And if the debt raise doesn't come through, the capex plan of 50 to 50,000 crores, which Vodafone Idea had announced for the next 3 years, that would also potentially come under pressure. So, all those are moving parts, and even otherwise, Vodafone Idea would have required seamless execution, if one were to be very bullish at rupees 15 plus stock price levels. So my sense is that till clarity emerges on all these, the stock might remain weak.
What was your base case, Balaji? In terms of a target price for Vodafone Idea, 15 rupees?
So my base case target price is 17 rupees, and that includes rupees 5 relief from the AGR verdict. So that now might get completely knocked back, and the rest is also contingent on the funding happening, including the debt funding, the execution of the capex program, and subsequent arrest in terms of the subscriber losses.
Hard for Vodafone Idea to go ahead and get that bank funding? Anyway, this kind of throws the spanner in the works. So otherwise, what would have been pretty straightforward now gets complicated because of this.
Okay, all right, Balaji, thank you so much for joining in today with your quick thoughts. That's the big news flashing at the bottom of your screen. The Supreme Court has rejected the recomputation of AGR dues by the telecom companies, which is Vodafone Idea and Bharti Airtel. Vodafone Idea.
I think Indus Towers is the stock you also need to focus on, because Indus Towers has slipped 10%. Remember, this is a stock whose part of its fortunes are tethered to that of Vodafone Idea, the strength of Vodafone Idea. So Indus Towers too is now down 10%, and also Indus Towers has been a big outperformer. Year to date, even after the correction, it's still up 93%. So negative news for Vodafone Idea, Indus. For Bharti Airtel, yes, it's a negative news, but maybe in this, there is also an opportunity for the company to go ahead and increase market share at the expense of Vodafone Idea. And we should pull up Reliance Industries too, as the owner of Reliance Jio. They don't get affected, they don't have AGR dues, but they could benefit from an increase in market share.
Okay, all right. Thank you, Rima, for explaining that for us. And thanks to Ashmit as well for joining in with all those important details. The sector continues to be in focus. But it's time for a short break now. When we come back, we'll get you more on the markets on the other side. Stay tuned.
Welcome back. The mid-cap index is still down over 2%. There is pressure in Vodafone Idea and Indus Towers, and that's big news breaking on your screen that the Supreme Court has rejected the AGR recomputation plea, which was put forth by the telecom companies. There's going to be a cash flow impact for Vodafone Idea, and Indus Towers too has fallen. PN Gadgil continues to react adversely for the second day in a row, so profit booking 10% lower circuit over there. Bajaj Housing Finance too is now at 156, second day of cuts. The high on Bajaj Finance earlier this week was 188.5. But Sudeep Shah is now the head of technical and derivative research at SBI Securities, is with us on the show. Sudeep, markets got what they wanted, right? That 50 basis points rate cut, but you can see that we're unable to hold on to the high levels, and there is a big correction seen in the mid and the small cap sector.
Good morning, Rima. Absolutely. I've seen what's happened is that post that initial move early morning and testing a fresh life high, Indian markets have followed the US markets, which also rose yesterday night before that rate cut, and then it witnessed profit booking. So I feel from the current levels, if we see firstly, if we talk about Nifty, I feel the support comes around closer to 25,250, 25,300 zone. And because of Bank Nifty, which has outperformed, we feel that Nifty could take support somewhere closer to 25,250, 25,300, and then consolidate from here on. So for Nifty, this is an important support. And for Bank Nifty, 50,600, 50,500 is an important support. And we feel from this current level, Bank Nifty could be bought on dips, and it could head higher to 53,500, 53,700. And if we just speak about Nifty mid-cap, now this is the first day after, I guess, from 8th of August that we have seen such a steep fall. And with this fall, mid-cap index has not also broken its say last 7-8 days of the trend, which was on the upside. It has even broken its 20-day exponential moving average, and now it's heading a bit lower, closer to 57,300, 57,500. So I feel in the next few sessions, it would be a clear demarcation between the large caps and the mid caps, and large caps would continue to hold an upper hand, and we should concentrate more on the large cap side and quality mid caps.
Okay. So quality mid-caps, that is something that a lot of market experts have been talking about as well. By the way, the Nifty is down 200 points from the highs as we speak. Sudeep, what are your technical bets in a market like this? We are seeing everything which is coming off the highs of the day. 91 of the 100 mid-cap stocks are trading in the red right now.
Yeah, so one stock which we like is ICICI Lombard. Now, ICICI Lombard was in an uptrend since mid of May, from 1550, 1560 levels all the way up to 2300 levels, 2250 levels, and post that it witnessed some kind of a profit booking from higher levels. But since last 3 days, we are seeing strong traction in this stock from the support zones. And today also, while there is a lot of selling pressure in the mid caps, this stock is standing strong. And we feel from the current levels, ICICI Lombard can be bought with a 21.30 stop loss for a target of 22.50. And this could regain its original momentum, which it was witnessing in the last several months. So I feel ICICI Lombard is one of the top picks. And the second stock that I like is from the FMCG space. Now, the FMCG space since morning is still holding well. And within the FMCG space, I feel Nestle has given a good breakout now. It has given a 4-month breakout. And from the current levels, this could be bought with a stop loss of 26.10 on the downside. And the targets could be placed closer to 27.20 and 27.50 levels on the upside.
You know, since yesterday, there have been a lot of buy calls on Nestle India. If you pull up that 1-week chart, even yesterday the stock was higher, and so many of the experts we spoke to had recommended it. Thank you, Sudeep, for joining in. With that, it's a wrap on Trading Hour from the entire team. Thank you for watching.